Most startups stumble on at least one of these 5 financial projection errors. Is yours next? Stick around and we'll show you how to make yours bulletproof. For new startups, creating solid small business financial projections is a must, but it's where many stumble early. Today, we're exposing the 5 biggest and most damaging mistakes founders make with their initial financial forecasts, and crucially, how you can steer clear of them from day one. So let's talk about mistake number 1, the too good to be true revenue dream. This is where your small business financial projections show massive, unsupported revenue growth, just going up and up and up, often based more on hope than hard data. The whole point of financial projections is to show what your business can do and how much you're going to spend to make those sales. If you're not realistic, then the numbers are just fantasy. And you're not running a fantasy business, you're running a real business. So think about reality. What can you actually do? And you're almost better off being a little bit more conservative than crazy fantasy, because crazy fantasy will make you make poor decisions. So let's talk about mistake number 2, the oops, I forgot that cost catastrophe. Startups often focus on the big, obvious expenses, rent, I've got to purchase the truck, all these big things, but they might miss a whole raft of smaller yet significant hidden costs. This can mean that you are not being realistic with your expenses. It's going to mean that it potentially will put your business at risk of failing or running out of cash. If you don't know if you have all your expenses, this is where Google is perfect. You can actually look up and see common expenses for your business. You can use a tool like LivePlan and look at the industry benchmarks and see all the benchmarks, and that'll help you make sure that you don't miss anything. But you want to have a realistic view of all those expenses, because then you understand if this business is even viable. So mistake number 3 is a classic, especially for startups, because you're not used to running this business. Confusing profit with actual cash in the bank. They are different, profits and cash. So how are you going to avoid this mistake, and why is this going to impact your business? We oftentimes, when we're putting projections together and first running a business, look at that profit and loss, right? Everybody wants to know, is your business profitable? Is it going to be profitable? That's all we hear. But at the end of the day, you can actually plan for your business, especially because you're starting up that first year, maybe even the first 2 years, to not be profitable, because you have a ramp to get going. But in order to do that, you've got to have cash in the bank. So you have to put together a cash flow forecast, and you have to manage both that cash forecast and that P&L hand in hand, month over month, as you're running that business, so that you make sure that you don't run out of cash and you have a runway to get to profitability. So what's mistake number 4? That's the if you build it, they will come. When you create your small business financial projections in a vacuum without truly understanding your market or your competition, this can be a big, big problem. You need to be realistic. That word comes up again and again when you're putting together your financial projections for this startup. You need to be realistic about what it's going to cost you to get those sales in the door. How much money are you spending on marketing? If you're not sure, this is where industry benchmarks are phenomenal. But you want to be realistic. Maybe in your industry, most businesses are spending 20% of their sales revenue on marketing. You shouldn't then be projecting 5%. So just because you build it doesn't mean that they're gonna come. You've got to make them with marketing, with advertising, with understanding your competition. So what's the last mistake? The set it and forget it. This is where you create your initial small business financial projections, maybe because you need to get a loan, you're putting a business plan together, you're maybe getting some angel investment. But then you never look at those financial projections again, and you don't update them. Don't make this mistake because you're actually leaving a lot of potential profit and margin on the table when you do that. When you first put your financial projections together as a startup, there's a lot of unknowns. As you actually open your doors and start selling and customers start coming, you're going to learn a lot of information. A lot of your assumptions might need to be slightly adjusted or maybe adjusted in a big way. Put together the projections and then every month, see your actual results and compare them to those projections. Look at the variance and then make adjustments. You're going to see, you're going to learn your numbers, you're going to understand your business, and you're going to make better decisions. So did we miss any major projection mistakes you've encountered as a startup? Let us know in the comments below. Your experience can help others. We really want to hear from you. And if you found this guide to small business financial projections helpful, please give it a thumbs up and subscribe for more essential startup advice. It really helps the channel reach more founders like you.